In the previous episode, we looked at the first two criteria used to determine whether a lease should be classified as operating or finance. And remember, this test is simple in structure. If the lease meets any one of the 5 criteria, it's a finance lease. If it doesn't meet any of them, it's an operating lease. In this episode, we'll continue that list and walk through the remaining 3 criteria. So to begin, the third criterion focuses on the lease term. ASC 842-1025-2C says that a lease is a finance lease if the lease term covers a major part of the remaining economic life of the underlying asset. However, there's also an exception here. If the commencement date is at or near the end of the asset's economic life, this criterion doesn't apply. So let's break down what that actually means. To start, let's look at what the standard means by a major part of the remaining economic life. Luckily, ASC 842 gives us some helpful guidance here. In the implementation section, FASB explains that a reasonable approach is to view 75% or more of the remaining economic life as a major part. And if the commencement date falls within the last 25% of the asset's total economic life, this test doesn't apply at all. So the practical takeaway is this: if the lease term covers at least 75% of the remaining economic life, and we're not already near the end of the asset's overall life, this criterion would be met and the lease would be classified as a finance lease. Now, the standard doesn't require you to use this exact 75%, 25% benchmark. ASC 842 simply says this is one reasonable approach. But since FASB lays it out directly in the implementation guidance, most companies follow it. There's really no benefit to creating your own threshold or overcomplicating this test, so using the 75% and 25% guidelines is generally the most practical and consistent approach. Now we need to turn to the lease term itself. ASC 842 defines the lease term as the non-cancelable period during which the lessee has the right to use the underlying asset, plus any optional periods that we are reasonably certain to exercise, or any optional periods to extend controlled by the lessor. That includes renewal options we're reasonably certain to exercise, termination options we're reasonably certain not to exercise, and any optional periods controlled by the lessor. All of these pieces together make up the lease term. Let's walk through a quick example to see how this works. Say we lease a piece of machinery for 2 years, and the contract includes an option to renew for another 2 years. We've already determined we're reasonably certain to exercise that renewal, so our lease term is 4 years. At commencement, the asset has 5 years of remaining economic life. And when it was first placed in service, it had a total economic life of 15 years. So first we check whether we're in the last 25% of its total economic life. We're not. 5 years remain out of 15, so there's still 33% of its life left. Then we compare our 4-year lease term to the remaining 5 years. Since 4 years is 80% of the remaining economic life of the asset, the lease term covers a major part of that life. So under this criterion, we would classify the lease as a finance lease. Now we can move on to the fourth of 5 classification tests, which focuses on the fair value of the underlying asset. Here we ask whether the present value of the lease payments plus any residual value guaranteed by the lessee that isn't already included in those payments is equal to or exceeds substantially all of the asset's fair value. If it does, we classify the lease as a finance lease. And don't worry, we'll cover residual value guarantees later in this series. Just like the last test, ASC 842 also gives us a reasonable approach for thinking about what substantially all means in this context. In the implementation guidance, FASB explains that considering 90% or more of the asset's fair value to be substantially all is a reasonable way to apply this test. It's not a required bright line, but it is the benchmark most companies use in practice. So if the present value of your lease payments plus any residual value guarantee not included in your lease payments comes out to 90% or more of the asset's fair value, This fourth criterion would be met, and the lease would be classified as a finance lease. And just like residual value, we'll cover what exactly makes up our lease payments and calculating their present value as we move forward in the series. And finally, we come to the last criterion in the classification test. Here we look at whether the underlying asset is so specialized that it's expected to have no alternative use to the lessor at the end of the lease term. If that's the case, the lease is classified as a finance lease. This one does require some judgment, but the idea is straightforward. If the asset has essentially been designed or customized for a specific customer or purpose, and the lessor wouldn't be able to use it for anything else afterward, then this criterion would be met and we'd classify the lease as a finance lease. And that covers all 5 criteria in our classification test. Now before we wrap up, let's quickly recap where we are. We're in the third step of our lease accounting process from the lessee's perspective, and in this step we need to classify the lease. To do that, we apply a 5-part test. First, does the lease transfer ownership of the underlying asset to the lessee by the end of the lease term? Second, does the lease give the lessee an option to purchase the underlying asset that it is reasonably certain to exercise? Third, is the lease term for a major part of the remaining economic life of the underlying asset? And is the asset not already near the end of its economic life? In practice, we'll use more than 25% remaining of the total life and 75% or more of the remaining economic life as our guideline. Fourth, is the present value of the lease payments, together with any residual value guaranteed by the lessee that isn't already included in those payments, equal to or greater than substantially all of the asset's fair value? And in practice, we'll treat 90% or more as a reasonable benchmark for substantially all. And finally, the 5th test is the underlying asset so specialized that it is expected to have no alternative use to the lessor at the end of the lease term. If we answer yes to any one of these 5 questions, we classify the lease as a finance lease. If we answer no to all of them, we classify it as an operating lease. What you'll notice about these classification criteria is they really focus on economic ownership of the asset. In practice, if the lessee receives ownership, uses up nearly all of the useful life of the asset, pays an amount that is nearly equal to outright ownership, or has an asset so specialized it is only useful to the lessee, ASC 842 treats the lease as a finance lease. If none of these are the case, in practice the lessor retains economic ownership of the asset and will classify it as an operating lease. So now that we know how to classify a lease, we're ready to move on to the next step in our process, the initial measurement and recognition of the right of use asset and lease liability. We'll start that in the next episode.